Hey everyone, Kevin here. Today I have a substantial update for you on key findings coming to us from not only the Federal Reserve, but also large commercial banks like JP Morgan Chase. I'm going to be breaking down these key findings so we can understand what's going on right now in the economy. Obviously, we know things are shut down, but if you're interested at all in making money in the stock market, in the economy, in investing, in real estate, this video is for you because I'm going to summarize and comment on the top most important things, and some of these things are surprisingly shocking. So let's get started and go right into it. Number one, a lot of us are focused on the mortgage crisis, but we're slightly blind to a potential crisis in autos. That is, a lot of folks might be in a position to where they cannot make their lease payments or their actual auto payments. This could lead to a cluster of defaults in the auto sector. That's going to be something specifically we want to pay attention to as defaults begin to rise. In addition to that, the Federal Reserve is reporting that auto dealers are almost completely dead, even though a lot of them are remaining open as they've called their service departments essential services, which somewhat makes sense for auto repair. They're still trying to sell cars, but the Federal Reserve found that dealers are expecting March sales to be lower than a year ago. That makes sense. With sales close to zero in April, and auto dealers are reporting significantly lower prices for used cars and new cars than they have before, which that almost sounds like a car ad commercial because I feel like we're always hearing discounts on cars. But the fact that they're expecting sales to be close to zero in April is quite concerning for autos. It makes sense why we're seeing Ford get punished so much. In fact, Ford just took on new loans to stay afloat, and they're paying 10% interest on those loans. Also, because of all the money the Federal Reserve is printing, a lot of us have been concerned what is going to happen with inflation. Well, right now, and this is pretty typical during a recession, inflation is actually declining to where we might actually see deflation despite all of the money printing that Jerome Powell is doing over at the Fed. Part of this is due to falling oil prices. Part of this is also due to high unemployment. Anytime the unemployment rate goes way up, the cost of labor tends to go down. We actually see less inflation because of that. However, there are reports of the prices of eggs and certain necessities nearly doubling, where prices of premium foods, by contrast, are falling due to decreased demand. One grocer noted that unsold premium steaks were being turned into ground beef because ground beef was out of stock. On top of this, the Federal Reserve is finding a lot of absenteeism as people decide not to go to work. It's unclear whether they're filing for unemployment because they're choosing not to go to work, or they don't want to go to work for fear of getting sick. Obviously, big hits to manufacturing, as a lot of manufacturing is shut down, like manufacturing for cars and washing machines. Tesla's Fremont facility is shut down. Then, interestingly, hospitals are also reporting declining revenues as people postpone their elective surgeries, which are usually a lot more profitable for the hospitals. As far as real estate, according to the Federal Reserve, residential real estate conditions have held steady through the entire month of March, and at the beginning of April, they're starting to see a decline in sales volume, but not yet a decline in prices, though the expectation is because a lot of deals are getting delayed because of what's happening, we're probably not going to see changes in sales prices until late April or May. Remember, real estate takes a little bit of time to catch up to what's happening in a market like this. Sometimes real estate can lead, but in this case, real estate is following. And so far, at least the data that we've been polling here on this channel, real estate's been holding up at least through the first week of April. Stay tuned, of course, for more updates on real estate. Now, in terms of banks, a lot of banks are actually noticing substantial increases in cash deposits. We're also seeing the Federal Reserve note massive increases in the amount of commercial loans outstanding. This is partially because a lot of companies are taking on loans, or they're doing something known as drawing their credit lines, which is kind of similar to taking an advance on your credit card, except the interest rate is way low. And they're parking that cash into bank accounts. So banks have more cash, which is good because then banks have more money to lend, which is good. It keeps sort of the wheels of the system grease. And a lot of people are taking money out of these credit lines, which I've recommended doing as well, because there are some banks who are strapped for cash actually freezing credit lines. So a little bit of good news and bad news here. But this is also a good point where I can talk a little bit about what's happening over at Chase. By the way, quick note before I get into the crazy things happening at JP Morgan and Chase and this sort of lie of an earnings report. This is kind of an expose here on the stock market. I do want to encourage you to join me in my programs linked below. I go live every day at 9 a.m. when the market is open, and you get some incredible course content as well. Use that coupon code extended through the end of the month as we wait for those stimulus checks. Now, something substantially that I noticed is actually quite different from what I saw reported by a magazine like Fortune. Fortune mentioned that JP Morgan profits plunge almost 70% as the first big banks report their ravaged earnings. Well, that's not what I actually found in the earnings reports. The first thing I noticed is that cash deposits, like cash Chase has on hand, went from $1.5 trillion in December to $1.8 trillion, a substantial increase over the last quarters that we've seen. But also, compared to this Fortune article, I'm not seeing the 70% losses here. And the reason for that is something very simple called the provision for credit losses. Basically, Chase went in and said, all right, here's our JP Morgan division. We normally put aside $1.4 billion for losses on loans, like people not paying their credit cards or their mortgages or whatever. They usually set aside $1.4 billion. That's what they set aside in Q4 of 2019. Well, in Q1 of 2020, they just set aside almost 5.5 times that. At JP Morgan alone, they set aside $8.2 billion for losses. On the consumer side, they did the same thing. They set aside an additional $4.5 billion for credit card losses, another $1.3 billion in losses for corporate and investment banks, another $900 million for commercial banking sectors. In other words, they took this money and kind of earmarked it, thinking that, okay, we might lose all of this money that we set aside. They didn't actually lose it yet. In other words, this earnings report is actually really, really good, because what it does is we get articles like this that say JP Morgan profits plunge almost 70%. And that's like, oh my gosh, that's terrible. The world is ending. Well, next quarter, when there are mortgage losses and there are credit card losses, we're not going to see that bad news anymore because it's already been announced. They've already set aside like billions here for credit reserves, which is really, really good. Because even though we're expecting really bad earnings going forward, if companies just report really bad earnings right now, which we're expecting, and then they start reporting normal earnings as our economy normalizes again, we might actually see that U-shaped or V-shaped recovery happen rather than a big secondary crash. Now, I know a lot of us are thinking, no. Once earnings come out, we're gonna see a big fat W and a secondary crisis. A double dip is coming. But if every company continues to report earnings like this, and especially if they over set aside, that is, they put more money aside and they're more conservative, I don't know, we might not see it. In other words, losses will have to be substantially more than the massive sums of money they already set aside, which is like 5 to 6 times the normal losses of money that they're setting aside. This is a lot of money set aside. And to me, this is a little bit of a trick in terms of what's going on in the stock market. So you want to keep an eye on this, because this is actually really good news. Now, here are a few more updates. Obviously, we're seeing hotels and hospitality workforce reductions of like 90%. I mean, they're basically shut down. And because of this, companies are actually relaxing temporary background checks and drug tests for people that they're hiring. So there might be an opportunity for a lot more people to get a job who otherwise could not have, which makes sense in a time like this. Now I want to show another piece of data here from the Federal Reserve, because a lot of us are looking to Bitcoin for potential safety, especially as we see, Jerome Powell again, cranking bank and the money printer. So we're thinking, you know what, we might want to shift at least some of our investments to maybe something that'll be more protected against inflation. This is an incredible graph. I'm going to share this right now, but before I do, make sure to get your 2 free stocks with Webull. When you deposit just $100, you will get up to $1,400 in free stocks, and at the very least, you're going to get an awesome stock trading platform that really helps you keep track of what's happening in the futures market, what's happening after hours and pre-market. Webull also has the largest extended hours for trading I have ever seen. They let you trade pre-market from 4 a.m. to 9:29 a.m. because the market opens right after that, and then from 4 p.m. after the market closes all the way to 8 p.m. That's insane. That's a really big pre and post market trading window. So I want to take a moment here and zoom out and look at the consumer price index. This is CPI. This is generally how we measure inflation. And we can notice the last time we saw a dramatic decline in inflation was actually an almost 4% decline in the measurement in November of 2008, which is a huge drop during the last crisis. We have not seen that kind of negative inflation, or basically deflation, well, basically ever, but we saw some shortly after a 9/11. But let's zoom in a little bit more recently here. So let's narrow this chart down and let's see what's happening just in the last few years and of course the last few months. So when we zoom in here, we're going to find that our last reading here is actually from March of 2020, and we are showing a reading of negative almost 1%. So almost negative 1.1% as an inflation reading. This is at the same time as trillions of dollars are being printed. The last time we saw a decline like this was in January of 2015, where we had a decline of 1.5%, which is very substantial. But you could see things have kind of sort of bounced around this 1 to 1.5% range in the positive. The Fed's goal, obviously, is on an annual basis to have inflation be around 2%, but this is a substantial decline here, despite the money printing that's going on, which is definitely shocking. It's also going to be shocking to see what the data looks like in April. But for now, this is the best we have. So putting this data together is obviously difficult. I ran a community poll on YouTube, and almost 2/3 of you believed that this is just the beginning. We are going to see substantial crashes and reductions in stock market values and prices going forward, especially as more news breaks over corporate earnings and how bad things really are. And once we actually get a true picture of unemployment numbers, and you know what? This could absolutely happen. But so far, as the data comes out right now, I'm not seeing inflation, which means we're probably not going to see interest rates ramped up. If we saw a lot of inflation happening right now and interest rates had to come up, yeah, we would see a really nasty future coming our way. But we're seeing deflation. We're actually seeing the opposite, which means, hey, you know what, Jerome, keep printing, keep those rates low, which is mind-blowing. It doesn't make sense. It's confusing. Also, the first round of corporate earnings that we're seeing, and it's not just Chase, it's also Goldman Sachs. Their earnings report looks just like this. Bank of America, they're all doing the same thing. They're over-reporting massive losses in the first quarter. It's almost like the CEOs are going, you know what? Everybody's freaking out right now. Let's just give them all the bad news now so that in Q2, 3, and 4 of this year, all we have to give them is great news because they're expecting the bad news now. So give them what they're expecting. And then when they're expecting bad news going forward, it's going to be good news and the stocks are going to rally again. I don't know, obviously. All I want to suggest is let's look at the data very closely here. And if you're starting to feel like, wow, things are just all messed up and manipulated, totally don't blame you. Personally, though, the more and more I track these earnings releases, the more and more I track this data coming from the Federal Reserve, the more and more I actually feel comfortable continuing to buy on red days. So far, I have bought on almost every single red day since the beginning of February over the last 2.5 months here, and I plan to continue. At this point, I do not see a reason to stop buying. I would only stop buying if I really started seeing inflation skyrocket and I started seeing numbers that actually concern me in these earnings reports. Again, I know bad news is coming. I'm not trying to say there will not be a double dip, but based on this information, I don't know. So let me know your perspective in the comments down below. Get your 2 free stocks with Webull. Get your quote and sign up for life insurance within just 5 minutes. Lauren and I signed up and it was somewhere between $35 to $45 per month. Pretty inexpensive. Folks, join me in the courses down below. Thanks so much for watching and until next time.